Good afternoon and welcome everyone to today's US market update and first quarter earnings review. Great to see so many on today's webcast. My name is Kelly May, Associate Portfolio Manager, and with me today are Fortrend CEO Joe Forster, along with Portfolio Managers Stephen Lyle, Chris Wallerman, and Andrew Corcoran. We welcome question and answers throughout the presentation. Please feel free to click on the Q&A tab at the bottom of your screen, and we will do our best to answer the questions as best as we can. With that, I'll now turn the presentation over to Joe.
Thank you, Kelly. The market continues to run largely on the back of this quantitative easing, but also on the COVID recovery. S&P 500 up 5.5% this month, while earnings estimates for next year were up only about 1%, pushing the forward-looking price-earnings ratio just above 20. So we're paying for 20 years worth of earnings adjusted for growth. The 10-year Treasury yield continues to go up from 1.4% to 1.67, which is reflecting increased expectations of a recovery, but it's not implying any inflation. The foreign countries that issue U.S. debt, emerging markets, or European countries that are also linked in many ways to the U.S. 10-year Treasury, have seen yields rising, in fact, doubling from about 50 basis points to about 100 basis points on those foreign issue debt. So we are seeing increased flow through on the U.S. 10-year Treasury into foreign markets. The G7, for those of you who aren't aware, is made up in Europe of the UK, Germany, France, and Italy, and that's 4 of the 7. And then there's the US and Canada. So, and then add to that Japan. So that's the G7. Note that there are several countries that are not in that group. China, for example. We bought Boeing mid-month. Bought there is spelled the way we would fill out a trade ticket, not normal spelling. Viacom was up on a lot of purchase buying pressure, and then fell down because of a hedge fund company called, and many people pronounce this different ways, but let's just say Archegos, was caught in a big margin squeeze. So the big news this month was the rapid rise in the number of stocks like Viacom and Discovery and a few others, and then the margin selling and the systemic risks that's exposed in the marketplace, which we had hoped would have been resolved 10 years ago by Dodd-Frank, the financial regulations bill passed by Bernie Frank and Barney Frank. So Dodd-Frank did not solve this systemic risk. So expect the SEC. Well, the way this worked is that this family office was not a fund. And because it was not a fund, it was not required to disclose its holdings in a public statement. So the first thing they did is they hid under the radar by being a, quote, family office. And then the second thing they did, instead of buying these stocks, they bought swaps into the stocks that were manufactured by Wall Street firms. So there's Wall Street manufacturing swaps again for anything anyone wants to buy. So that was able to allow this Archegos hedge fund to buy these stocks with 8 times leverage. And then the swaps were, of course, owned by Wall Street firms, and there were margin calls, and the thing came tumbling down. We'll go into more detail on that, but there has to be transparency on these swaps to expect the SEC and Congress to come down hard with new laws.